Welcome to the Alts Insights podcast, a look at the latest trends we're seeing in the alternative investment universe. AI Insight covers over 200 non-traded alternative investment funds representing nearly $35 billion in assets and over 80 alternative strategy mutual funds, representing 80% of the AUM of the alternative strategy mutual fund market.
Welcome to the Alts Insights podcast, hosted by AI Insight. I'm Heather Muckle, and I'm here with Sherri Cooke to talk about her observations of the alternative investment industry in 2019 and her thoughts on what's to come in 2020. Sherri Cooke is the CEO and founder of AI Insight. She created AI Insight in 2005 with the goal of providing the financial planning community with a consistent resource of fact-based information on alternative investment programs and an easy way to do quick, fun comparisons on hundreds of key data points. The AI Insight database supports hundreds of financial firms and thousands of advisors with a means to establish regulatory and fiduciary best practices when considering alternative investments. Thanks for joining me, Sherri.
Thank you, Heather.
Great. Let's kick off our conversation with a look back at last year. Can you talk about some of the key reflections you have about 2019 from an industry perspective?
Sure. Let's start with some of the most notable overall industry growth and trends that we saw on the AI Insight platform last year. You know, we had a couple of all-time highs. We had a record year in terms of bringing new funds onto our platform. We also added 200 private placement programs, more than ever before, with record months in November and December. So we really ended the year on a very strong note. But you know,
Great.
why don't I I'll break it down and talk a little bit about the public side and then the private. Those are kind of the high levels. So first, maybe a little bit on the public side. There were 13 new public funds that we added in 2019, and I can give you a quick breakdown of those. We had 4 new non-traded REITs, 3 new interval funds, 3 new non-traded BDCs, and 2 new public preferred offerings. And I think probably the biggest story on the public fund side was the fact that the increase in capital raise in non-traded REITs was significant. You know, the numbers for fourth quarter and the full year 2019, haven't yet been filed, but the industry had already exceeded 2018 by over $2 billion as of the end of third quarter. So we saw a pretty significant trend here. While I think the trend here is primarily a result of Blackstone's REIT, with nearly 72% of the total industry raised, they clearly continue to dominate this market. Their REIT actually raised over $1 billion a quarter in Q2 and Q3. That's more than any other non-traded REIT in the history of the industry, so that's pretty significant.
Yeah, very significant.
All right, so, but the other non-traded REITs, they also saw increases. In Q3, all but 2 of the non-traded REITs saw gains in their capital raising. And then last quarter, every single non-traded REIT on the platform saw an increase in their quarter-over-quarter raise. So, we're seeing that this rising tide does seem to be lifting boats with a capital raise ramp up, with all the active non-traded REITs, especially the NAV structure REITs that are similar to Blackstone.
Okay, that's a great analogy. The rising tide seems to lift all boats.
Yeah, it does. And that's a good thing. We'll start seeing some of the, the positive trends, and you get a little bit of that domino effect. So that's a direction that we'd like to continue seeing. Okay, so let's talk a little bit about returns. The Stanger NAV REIT Total Return Index and the Stanger Life Cycle REIT Total Return Index, as of 12/31/19, posted 3-year annualized total returns of about 7.5% and just over 4.5%, respectively. This is compared to the MSCI REIT Index, which posted about an 8% 3-year return. But you really need to look at the volatility in the traded REIT markets.
Okay.
It's interesting to note that the MSCI REIT Index has a 3-year standard deviation of over 12%, and had a maximum drawdown of almost 74% back in 2007. Now, we're talking all these numbers, and at this point, this is when I really wish I could share a visual, because a graph right about now would be worth 1,000 words.
It would be helpful.
I know, it's so frustrating. But anyway, one thing when listening to the numbers that's really important to remember is that direct real estate doesn't behave like traded REIT markets do, and they're not supposed to. They're intended to provide a relatively stable income over time, diversify the risk in a portfolio, and provide downside protection, one of which can be an inflation hedge. And that's why that, the volatility that you see in the traded markets is exactly why you want to consider diversifying into a non-traded entry into the real estate sector. So anyway, you always want to look at the returns of the markets, but the non-traded REITs do provide a different stream of returns and value.
Okay.
Another thing I'd point out was that the perpetual life, or the NAV REITs, had a much narrower range of returns over both the 1 and the 3 year periods than the life cycle REITs did.
Okay.
Again,
can you tell me more about that?
Yeah, sure. Returns on life cycle REITs are probably less predictable in their returns during the life of the program, but they are positioned to be more opportunistic over the life of the program. Whereas, I'm going to point out just some of the range of performance. So, like over a 1 year period, the difference between the best and the worst performers for the perpetual NAV REITs was about 9%. So there's a swing there, but not huge. But in the life cycle REIT space, the difference was about 58%. Yeah, so this makes sense. I think given the fact that the NAVs really need to be more focused on core, stabilized real estate, so they can post those stable NAVs. Whereas the strategies and the types of assets that are in the life cycle REITs, can be very different. And again, I referred to the fact that they can pursue more opportunistic strategies since they aren't reporting NAVs on a daily basis. That spread might be a little bigger than we would have expected, but still, I think that's probably the reason why you see the variance.
Okay.
Okay, so shifting gears a little bit, the main story in the non-traded BDC category is that the merger and subsequent listing between 3 former Franklin Square and 1 former CNL BDC will shrink this industry significantly, this segment of the industry. That merger closed in December of last year, and the listing is expected to happen in the first half of this year. And once it happens, it will create the second largest public BDC ever at $9 billion. And that will represent just a little less than half of the total $21 billion non-traded BDC market. So that's definitely a notable event that we've seen happening.
Okay, yeah, very significant. Okay,
so let's move on to talking about the private placements next. I mentioned that we added 200 private placement funds to the platform during the year, and they were slightly larger in average target raise than they were in 2018. So in 2019, the average target raise was about $58.5 billion. 2018, it was just under $56 million. Not a huge difference, but seeing a positive trend up in terms of the average target raise. And the range in size of these funds was actually pretty huge. On the low side, about $3.5 million, but it went all the way up to $2.2 billion. So a pretty vast range there.
Yeah. Can you talk more about the growth there?
The industry was led primarily by continued growth in 1031 exchanges, which is what we've seen over the last couple of years, where we added 99 new funds. We also had the addition of the Opportunity Zone funds, which added to this this particular sector. And we added 18 of those in 2019, and I'm going to talk a little bit more about that a little later in the segment. Private equity and debt activity picked up late in the year, as did conservation and energy funds. Other real estate, which includes non-1031 real estate LLCs and LPs, trailed in 2019 versus 2018. We added fewer funds in these categories in 2019, and the average target raise for those that we did add was significantly smaller than in previous years. We had 158 private placements closed to new investors during the year, and they raised approximately 85% of their target. Again, a positive trend. This is better than 2018, where we had 154 funds close in that year, and those funds are reported that they raised only 63% of target. So, again, positive trends in the alt space. As of January 1st, AI covers 172 private placements currently raising capital, with an aggregate target raise of just over $16 billion and an aggregate reported raise of almost $8 billion. So, so far in the fundraising cycle, we're at about 48% of target. In keeping with one of our key missions, which is to provide education on current trends, structures, and regulatory concerns, we created an Introduction to Opportunity Zone Funds, which is a CE qualified course, at the tail end of 2018. And we've continued to update that course as additional insight had been provided through the supplemental regulation. And while they've provided, I think, their final planned guidance, we'll certainly be watching in case anything else comes up that we need to keep you up to date on, and would certainly update that course as needed.
Okay, great. But expect it to be done. Well, we'll see. Yeah. We'll see what's to come, I guess. Okay.
Yeah, I mean, at least this was, that was what had been announced as the planned, regulatory updates. But as additional clarification is needed, I'm sure that we'll continue to get guidance from all sorts of sources.
I'm sure.
But we follow that really closely. We work with several law firms, and we're always following the regulations. So we make sure that course stays up to date and post marketing updates if it's important. Okay, so in the Opportunity Zone sector, we currently have 18 program-specific training modules, one for each of the individual Opportunity Zone funds that we currently have on the platform, with one entry that we have going on right now, and about 4 more that we expect to start adding over the next several weeks. So we've seen a real acceleration in the number of these programs finding their way to the IBD space, and we're finally starting to see some momentum in actual capital raise in this area. It's been pretty slow, and I think everybody wanted to wait until we got that final regulatory guidance and clarification. But the funds we currently cover have a reported aggregate capital raise of almost $700 million, and that's approximately 37% of target raise. So gaining some good capital raising momentum now.
Great.
We'll see if there's any effect in 2020 when investors lose that extra 5% of the maximum tax savings opportunity that they would have gotten if they invested by the end of last year. Or maybe it's just, taking time for the market to get the clarity it needs and, work out some of the operational questions and challenges to really get comfortable moving forward. So we'll see how the trends continue. I think we all agree it's a great concept. We'd like to see it work, but there's a lot of moving parts, and there was a lot of questions, and so we'll see.
And training needed. So yeah. I know we have a lot of training resources you can mention.
Yeah, sure. We did do a recording with Mick Law. We did a webinar with them, and that recording is available, and that includes stepping through an actual Quality Opportunity Zone Fund case study, which I think is really helpful. And I know that you guys, the marketing department, did a blog on AIinsight.com for an introduction. I think you did like an introductory FAQ on opportunity zones back in November of 2018. And then I think that we posted a comparison chart. When did we post that? It was a comparison chart between 1031s and quality opportunity zones. Do you remember?
Yep, that's also in our blog, and it's also a part of the CE course.
Oh, okay, great. Do you know if they're looking for the blog, when would they look for that one?
They would look for that in April of 2019.
Oh, perfect. Okay.
And then, and just kind of, thank you for mentioning those Opportunity Zone training resources. I know people have been asking for those, especially as they're starting to want to get more familiar with them. I second the recommendation on the Introduction to Opportunity Zones CE course you mentioned. Like I said, the comparison chart is in there as well as a lot of other information. It's a really great starting point if you want to start to get up to speed on opportunity zones. So,
yeah,
great, Sherri. Thank you.
Oh, sorry. I was going to say they're complicated, but I mean, it really steps through it and makes it really clear. They did a great job on that course, so thank you.
Great. Well, now let's get into some specific points of interest about AI Insight as far as what's being covered and how AI Insight expanded last year.
Sure. Content-wise, our goal is to continue to work and make it easier for people to access hard-to-find data that they need to help them source and compare alternative investments, kind of simply put. We're continuing to build our library of industry content through webinars, on our YouTube channel, podcasts like today, and blogs to keep you in front of alternative investment trends and kind of demonstrate how you can leverage the AI Insight platform to build a more efficient practice. We know it's really difficult to get out there and access what you need to help diversify and build your portfolio. And I think you guys recently did a blog that was published specifically about steps advisors can take to create efficiencies and help improve the success of their practices through those efficiencies. So I think that'd be worth checking out.
We did, yes. It was it just kind of pointed to the study of how advisor practices are structured and how they can be structured to be more successful and efficient. So, yeah, that's a great blog.
Great. Thank you. And, we also continue to increase our overall product coverage. As of January 1st, I mentioned that, our coverage includes 172 private placements. We also have 85 alternative strategy mutual funds. That's something that we launched last year. There are a lot of mutual funds, and the regulators have been pointing to this since 2017 and actually back to 2013, saying a lot of traditional mutual funds are not your traditional mutual funds, that they have complex trading strategies that are much more similar to the traditional alts than they are to a mutual funds. And that having been said, have heightened regulatory requirements and supervisory requirements. But from an advisor's perspective, I would just want to make sure I understood the difference and that, if it's going to be behaving more like a traditional alt, take the time to really dive in and understand them and do some of those comparisons. So that's news. We've got 85 of those, and we'll continue to add those. We've got 19 non-traded REITs and 24 interval funds. We also launched our industry reports last May. So we've been collecting key data points on alternative investment programs since 2007. And again, this is not your easy-to-access collectible information, right? Much of it's very difficult to access and even more difficult to aggregate. So we decided to take a part of our year last year and really invest in building out the behind-the-scenes infrastructure that now allows us to pull and aggregate valuable stats from the database. It's a continuing work in progress because there's so much data, so we're continuing to add reports. Right now, you get 24, but, there's probably an infinite number that we could continue creating. But doing this gives us the ability to provide data to support historical narratives and kind of highlight key trends we're seeing, evolving in the alternative space. And I think what's going to be especially interesting is to have some of those overlaid onto your traditional market performances and trends. So, something that we just haven't been able to do in the past because you didn't have the data points.
Okay.
Yeah, so
great. And I think the key word you said there was the difficulty to aggregate and the time save that we're providing there.
Yeah, absolutely. And I think that this is going to be particularly helpful to overlay these and provide, the ability to do comparisons between non-traded and traded securities around the eventual Reg BI or, regulation best interest requirements, because advisors are going to have a real understanding of how and why the investments that they choose are the best portfolio, choices given any other investment options. And And that's hard to do if you can't include alternative investment information into these comparatives. So our goal is to make that easy to do, and we can definitely help in not only the process there, but again, that all-important documentation of the efforts made, which is what, everything that everybody does on the platform is automatically documented on their training, education, and research logs.
That's an important thing too. It's automatically tracked, easy to access when you need it. Hopefully you won't, but if you do, it's there.
Yeah, and it's really interesting. Over the last year or so, we've been working on the insurance side, and as a result of these good best practices that are being put in place by firms, we have seen firms have significant improvement in their E&O insurance, and not just in their premium costs, but better coverage, a reduction in exclusions in their policies. So, by design, we want everything that's done on the platform documented behind the scenes, and we've always thought that was a good way to do it, and it's really exciting to see that some of that's playing out in net savings and better insurance coverage. It just makes sense, right? I mean, if you're doing the right thing, and you can go back later and be able to prove that you did the right thing, you're going to have a better chance from a liability mitigation perspective, and the insurance carriers are recognizing that. Okay.
Yeah, great.
So we've also, I talked a little bit about the alternative mutual fund research. So let me dive into that a little bit more. We're continuing to expand that, and that is another platform that I mentioned that we launched at the beginning of 2019, and that really followed the regulatory focus and guidance on areas that needed heightened due diligence and supervision and training. And it became apparent to us that there really seemed to be a lack of understanding and education around these alternative mutual funds, and funds that are utilizing complex hedging strategies. They might be using derivatives, and again, these complex strategies are making them look a lot more like traditional alternatives than traditional mutual funds. In expanding our platform, our goal was really to make sure we're providing the same level of best practices and access to the consistent information on these funds as we do with the traditionally structured alternatives, such as real estate, private equity, interval funds, and the like. So they can, advisors can get in and compare the details and the financial performance of the alternative mutual funds, all with all the same benefits that they have on the traditional alt side to facilitate their alternative investment research.
Great, and that's something we can help with too, is a lot of these BDs will do all fund company approvals. If they're needing help looking at their mutual fund list, that's something we can help with.
Absolutely, and so what we were encouraging and doing for all of our clients, and we'd be happy to do for anybody, is really kind of a alternative mutual fund risk exposure analysis. And what we found is a lot of firms have blanket agreements with family of mutual funds. That's, I think, traditionally the way it's been done, and there's not a lot of differentiation either at the due diligence or the supervision level about how you approach mutual funds. But very specifically, regulation calls out these complex mutual funds. So we can help firms say, listen, just send over your blanket list of your mutual funds. We'll narrow it down and tell you how many of those have been deemed to be complex or alternative, and then really drill down and say, what can we do to help you document your best practices so that there is kind of a bridge between that process that you have on the traditional alts with these alternative mutual funds. And it looks different. We're not doing product-specific training or anything, but there's some continuity to approach, which I think is going to be really valuable for firms. Not just, because you want to check all the right boxes, because it makes sense to do. If we see a big market correction and we see a lot of money start flowing into alternative strategies and people don't understand the complexity underneath them, I think there's going to be some problems. It's an educational process, though, right? Because there's just not a lot of people that have been talking about it. So we're really happy to go through that educational process with everybody.
Okay, great. Good to know. Okay, we've talked a lot about in-depth research reports and numbers. let's lighten it up for a little bit and change course. AI Insight is a multi-dimensional company, and it's really dedicated to giving back. So I just wanted to hear some more about that from you.
Sure, and thank you for this question, because I think it's a really important one, and it's really important to us. And of course, everyone at AI, we really hope that we're giving something to our subscribers that makes their lives easier and more efficient and more compliant, right? But we're all more than that, and we're also a company that loves to give back in all sorts of ways, to communities and causes that are near and dear to our hearts. So we created what we call Insights into AI, and it's a new section on our website that highlights this kind of special aspect of our company. And I actually love it. So, for example, we talk about my family has sponsored 3 orphans in Haiti for the last 13 years, and we picked them when our kids were little, and they kind of mirror our kids' ages, and it's a really special relationship, and it's actually evolved to the point where we're trying to develop a scholarship program to bring these kids over to the States. They work so hard in such incredibly challenging circumstances, and then they reach a point where there's no hope, right? They get to be 18, and then they have to go back out into the community. And our oldest, Moses, wants to go into politics. He wants to learn how he can go back into his government and make a difference. And God loves him. How can you not try to find a way to support that? Things like that have to have change from the inside out. So, so we kind of highlight, that's something that we do. We also walk dogs at the shelter every other week.
That's great. We have a lot of rescue dogs on our
Yes, we do. We have a lot of rescue dogs. We need to actually add that to start like a little photo album of all of our rescue dogs. Okay, so then my business partner, Jennifer, she and her family have sponsored what they call Mamas in Uganda. And interestingly enough, this was started by the daughter of Larry Goff, who many people probably know in the industry.
Yes.
And she's had that going, just a fantastic organization where they work to empower and train women to create better lives for themselves and their children. And as a matter of fact, Jennifer and her 13-year-old daughter are literally on an airplane right now on their way to Uganda, where she takes her children to actually visit with these women and children once, like a special trip. And so they're on that kind of service trip right now, which is pretty cool.
That's awesome. Yeah, and I know we have more about that on our Insights to AI page as well.
Yep, and some really fun and cool pictures. We also have 2 veterans on our team who we are incredibly honored to have and, proud of their service. One of them is extremely involved in Vietnam vet programs. He provides education to high school kids and, working with all sorts of educational volunteer programs, which is really cool. We have a beekeeper, if you can believe it, who's working on all sorts of educational volunteer programs around helping to repopulate our threatened pollinators, something that's really, really important. As a matter of fact, I think I may get a little, I think she's going to send me one of the little beehives to try and encourage bees.
You're going to give it a shot, huh, Sherri?
I'm going to give it a shot, yeah.
All right.
It's pretty cool.
Great.
And 2 of our team members are actually raising $30,000 this year for the Dana-Farber Cancer Hospital, and they're going to be running in the Boston Marathon this April.
Yeah, this is coming up fast.
I know. I don't know. That's better than them than me on that front, I say, for sure.
Thank you for sharing those examples, Sherri. I think it's really inspiring to hear the impact that people are making, and it's a lot of diverse interests that you mentioned. And since we started sharing these stories just with each other and on the team and then started sharing them with our audience, I think it's motivated more people to get involved with these organizations or ones close to their own heart. So I know we'll hear more coming this year. Okay, speaking of this year, we better wrap it up here. Let's talk about your thoughts on what's to come in 2020. AI Insights always focused on compliance and what regulators are saying. What are your thoughts there?
Yeah, we're definitely going to continue our watch on regulatory changes. Front and center is Reg BI, and we're always working to help advisors and the industry comply with those. It's funny. Compliance is one of the things. I don't know if it's funny or not, but compliance is one of the things that motivated me to create AI in the first place. I wanted to build the capabilities to facilitate due diligence and proper compliance, along with education and documentation, when selling complex products. And I had seen such an inefficiency in this space in being able to do that, especially around the products that regulators call out as needing heightened supervision and training. And so, from a company perspective, we've found that in any situation, when we're aware, if you can stay up to date on the requirements around selling an investment, which is difficult to do, so we want to help do that, and then you make sure that everybody involved is aware of their obligations and kind of adhering to that process, and you're documenting it, which is also hard to do unless you have a framework to do that. Then if you could do those things, then regulators are generally satisfied, and that's really been our experience with our clients. And a lot of them will call after their audits, and they'll just say, "Hey, we have this structure in place through AI." And they don't worry about it. They don't have to, dive into it. But, if you fail to make these efforts up front, whether you do it through our platform or in some sort of an internal process, right, and you're inconsistent in how you conduct your business from a compliance perspective, then you really are leaving yourself open, to trouble from a client who may end up unhappy down the road for whatever reason, and you just aren't able to come back and show a really clear path to education and supervision around complex products. And nobody wants to end up in the news for the wrong reasons, right?
Right. Absolutely. You're absolutely right.
Yeah. Okay, so maybe on the marketing side, I would say one of our key marketing initiatives in 2020 is we really want to help support the general question and the perspective, why alts at all, right? We talk a lot about it, and it's always been really important to us to drill down and provide access to product-specific training, because we think that's really, really important. But now that we do that, so consistently, we really want to step back and say, how do alts fit within the larger picture, right?
Right.
Why should you even consider them at all, rather than being in the middle of them and just wanting to learn about them? So I think, I think the traditional portfolio model has become challenged, and the endowment model, right, has proven to be a really successful strategy, and more investors are hoping to be able to access it. So we really want to focus on bridging that gap of understanding education between the institutional success and parlaying that over to individual retail advisors and clients being able to access and show those data points which will help tell that narrative. I think there's a growing complexity of investor needs, and more and more money is moving into the private sector through self-directed retirement accounts. So, the industry, as long as we can provide kind of that third-party independent access to what products are available, I think our next opportunity is to really provide a more broad-based education about how to meet those complex needs, right? Everybody knows, we've seen an unprecedented bull market, and, I'm not the only one who worries. I've got one child in college, I've got another two coming up right behind, and I have to look at it. And I go through the process myself. How do I reduce my risk of short-term losses that I don't have time to recover from, and diversify myself into non-market correlated investments and not have to put them into bonds, right? How do I try to get some stability and yield? And that's where the education around why alts comes into play. I think there's been a lot of, expectation that alts have to outperform the market. That's not what they're intended to do. And I think we have a real opportunity as an industry to do a better job of educating from a holistic perspective. I know we really want to expand our content, in terms of CE and webinars. We mentioned that earlier, and adding more and more that just address alternative investment performance, right? That hasn't necessarily been easy to capture, but it's a definite front and center initiative for us this year, and we want to make sure that we're expanding content to help support people access that and understanding it. And really adding those value-added narratives around the trends. Our first step was to provide the data points, right, which we're pulling in the industry reporting, and now we really want to provide that overall context. Before we close, I did want to invite everybody to join the next webinar in our monthly series, which will be on January 29th. We'll be covering private placements during 2019, and we'd love to have you all join us. You can register on the homepage at AIinsight.com. Just scroll down about halfway down the page on the right and click to register.
Yeah, this is a great place to come and actually see the visuals that you were talking about earlier,
right.
Sherri.
Oh my gosh, that was very helpful. It was hard to
go with the data. Yeah, so still a few days to register for that webinar, or if you miss it, just watch for our YouTube channel. We'll put the replay out there. And we're also putting together a webinar to cover Reg BI to help advisors prepare for that, so watch for that coming soon as well. And Sherri, thank you for taking time to talk with me today.
Yeah, well, thank you so much, Heather. I really appreciate it, and I look forward to having the opportunity to talk with everybody again. And we wish everybody a very, very successful and happy and healthy 2020.
Great, and thank you for listening to the ULF Insights podcast.